Hello, friends. My name is John Baldwin with John Hart Real Estate, and today is April 11th, 2022. What I want to touch on today is the impact of the rising interest rates on inventory. There are a slew of articles out today. Some of them touch on appreciation, some of them touch on inventory, some of them touch on, like mortgage lenders. Basically, the refi boom is over. Why? Because if you have a 4.5%, why would you refi right now? You should have refied when they were down at 3.5 or 2.5. So, refi boom is over. We all knew that was going to happen. That's going to actually make the purchase process easier for buyers. They're not competing with the lender's time, the appraiser's time for all the refis going on. So this is going to help buyers ease the process a little bit. It's going to make appraisers more available, which has been an issue. Sometimes appraisals will take longer than you wanted just because it's so tough to get an appraiser. So this should help with that. But what I want to touch on today, though, is from housingwire.com. There is an article called Housing Inventory Uptick Expected Within 6 Months. So this touches on a couple things. There's another article also on Housing Wire about how the higher interest rates are going to slow appreciation. These are linked. So when we have more inventory on, we have less upward pressure because we have more homes for all the buyers to chase. So if there used to be 100 homes and 1,000 buyers, we may have 200 homes and still 1,000 buyers. So it's fewer buyers per house on the market, if that makes sense. So what I want to touch on, though, and we'll get into this article, is, more than 2/3 of potential 2022 sellers expected to list by summer's end. This makes perfect sense if you know how interest rates and values are linked. When interest rates are super low, it's really easy for a buyer to throw an extra $10,000, $20,000, $30,000 at something, or in higher price ranges, $100,000, $200,000 at something, because they know that the cost of that money on their mortgage is going to be minimal. Now, with interest rates ticking up, that extra money, it's going to cost them more. So their payment, even if the price is a little lower, their payment may be higher. Go back and check out my video about, the impact of rate increases on your monthly payment. I did an analysis comparing $1 million purchase versus a $950,000 purchase, but the only difference was a 1% higher interest rate. You ended up with a higher monthly payment, as well as paying more interest through the course of the loan for the house. So you end up paying more for the house over time, even though your initial sticker price is lower. So this is what I want to emphasize. And that's why these articles are so important, to get this information out there, because there are, this is how, when interest rates rise, what I described it the other day to a client was like, last year we appreciated at about 19%. That's a pretty steep incline. As interest rates come up, that rate of increase decreases because your cost of money for the borrower is that much more. It's that's how interest rates affect the direction, the rate of appreciation of the market. So when my cost of money is more as a borrower, I can't easily throw as much at that property. So the rate of appreciation slows down. The other factor there is when you have more inventory coming online, when you have more supply, we can also slow that rate of appreciation. So these are two things that are indicating to me that we may be approaching a plateau. Or a return to more traditional rates of appreciation. The traditional rates of appreciation are usually in the 3 to 7% range, depending on other factors. So if we can return to a more normal appreciation and get to a more normal market, we can get it back off from this sort of frenzy that we've had for a couple years. But if you're waiting for the market to crash, I think you're going to be waiting a long time. That being said, why would we be waiting a long time? Because when the market crashed in 08, 09, what the cause of that was just we had bad fundamentals underpinning the whole market. We had a lot of subprime mortgages. We don't have that now. Everybody who's purchased over the last decade or so has had money, income, and credit, and so they had skin in the game. We're not dealing with those negative amortization loans. We're not dealing with the liar loans. We're not dealing with the you have a pulse, here's $500,000 loans. So we're in a fundamentally different place. So the market for real estate is really good, but we're in that sort of, I don't want to call it an inflection point. That's not the right terminology. We're basically in the sweet spot where prices are high for sellers still and interest rates are coming up. So we're about to see that appreciation metric change, or that angle of appreciation lower. And so we're in that sweet spot where sellers can maximize what they get and still get a good interest rate where they land. So give me a call, 213-973-3777. Let's get your house sold, because this is a phenomenal time to maximize what you get and still get a good interest rate on the back end. So give me a call, 213-973-3777. And as I said, let's get your house sold.